Good afternoon. It's Friday, April 17th. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our special weekly market update. Foster Group is an independent investment advisory firm headquartered in West Des Moines, Iowa, with offices in Omaha, Nebraska as well. We currently serve over 1,400 clients around the country, and we manage investments for people's personal money as well as institutional and retirement plans. Today, we're going to look at some of the market and financial and economic events of the week. One of the first things to note this week is that unemployment numbers continued to climb. But a detail in the numbers are that oftentimes claims by state are sometimes classified as permanent or temporary claims. And the good news is that it seems like temporary claims are making up most of the new filings, and we'll see a chart of that in a couple minutes. This week also saw the first major dollars of the CARES Act begin to arrive for small business payroll protection program loans, as well as the personal direct payments to taxpayers. A piece of good news this morning on the healthcare front was that Gilead's remdesivir has been showing positive results. Particularly, there's some talk of a 125-person study that was being done at the University of Chicago. Formal results haven't come out yet, but they were being spoken of this morning by people who are familiar with the trial, and they said it was very successful in that 125-person group that had already been hospitalized. In addition, new COVID-19 infection case numbers began to trend in the right direction, both in the United States and globally, which has fueled some optimism that economies may be able to open soon. In terms of financial markets, it was a positive week for equities globally. The Dow Jones U.S. Total Stock Market Index was up just about 2% at 1.76, while the Ishares MSCI All Country World ex-US, so stocks outside of the United States, was up just over 1/3%. On a year-to-date basis, we look at that same Dow Jones U.S. Total Stock Market Index. It's down for the year about 13.5%, which is significantly better than where it was just a few weeks ago. And the same thing for the MSCI All Country World. It's down now about 20% after having been down as far as 35%. In bond markets this week, the Ishares Core U.S. Aggregate Bond Fund, which tracks the U.S. aggregate bond market, was basically flat for the week, down 8 basis points. It's up 4.47% for 2020 year to date, which is exactly what you'd hope in a down market like the one we've been having on the equity side. You like to see the bond side of your portfolio providing the diversification, the negative correlation, so it's actually adding value to the portfolio even as stocks have been taking it away. The U.S. 10-year Treasury yield fell slightly this week, down to 0.64% after starting the year as high as 1.8%. So interest rates have fallen significantly over the course of the first few months of the year. Obviously, with the Federal Reserve lowering rates, rates in the general bond market have followed that trend. If we turn our attention back to unemployment for a few minutes, one of the economists who I read regularly is Greg Mankiw. Greg is an economics professor at Harvard. And while he was reviewing the March month-end jobless claims, one of the things he noticed was that the jobless claims, which are delineated between temporary and permanent, the temporary claims, in other words, those claims made by people who think their job loss will just be temporary, maybe they've been furloughed or laid off for a period of time, those numbers were extremely high. Those were the numbers that we saw in the paper, running around 6 million jobs over a 2-week period in terms of jobless claims. What he noted was that the permanent claims, and on this chart on the right, you can see those are the blue bars on the bottom line there, those claims had remained relatively constant. Now, this chart is a chart from California, which does track people's claims in terms of whether they're permanent or temporary in terms of when they make their claims. This is also done in the state of Washington and the state of Colorado. In both of those states, as they reviewed more recent information, the same trend is holding true. So most job claims or claims for unemployment that are being filed by people who think, we're pretty sure that their job losses are temporary. That bodes well for the economy. People are thinking they'll be back to work fairly quickly once we get past this COVID-19 health outbreak. The chart on the left just shows the degree of job losses in previous recessions and the speed at which those job losses occurred. You can see that in this one, the bottom, the lighter blue line, the amount of job losses that we've had has been commensurate, maybe a little bit larger than previous recessions, but it's happened at a much more rapid pace. Again, it's kind of indicating that many of these jobs were lost quickly. Of course, the hope is that they'll come back quickly as well. These are pictures that we look at every week just in terms of market benchmarks. What you see here is the S&P 500 in the light blue. We see the All Country World Index in the purple, and we see the AG, which is the Ishares ETF, which tracks the U.S. bond market. Basically a positive week across the board there. Again, if we look at year-to-date numbers, we talked about these things earlier, but it just kind of shows the trend. And on that stock market indices, both the S&P 500 and the All Country World Index, you can see they reached their bottom there, or what has bottom the bottom so far, at least at the end of March, and have been trending in the right direction generally since then. Earlier this week on CNBC's Squawk Box, they were interviewing the chief investment officer of the CalSTRS retirement program. The CalSTRS is the California State Retirement System. It's the second largest public retirement plan in the country. So Christopher Ailman, who is the CIO of CalSTRS, obviously gives direction to a lot of money. And when he was asked by the CNBC host what he was paying attention to in this environment, his answer was, it's really about looking at your overall asset allocation. That was good news, I thought, because historically, talking about asset allocation has been thought to be really the key to long-term investing success. So to hear someone like Mr. Ailman talk about the same thing, even in the midst of a crisis like this one, I think should give investors courage or hope that the things that we've thought about are important in the past are still very important for us to consider. As I thought about asset allocation, some of the questions that we've been receiving from clients have been about the different kinds of assets that are held in the portfolio and how they've been doing through this shock and maybe over the last few years. So I thought we'd do a quick review of what we mean by asset allocation. Asset allocation is really a portfolio's exposure to all the different types of assets and securities that are available in the world and to what degree. So asset types might include stocks, real estate, bonds, cash, and commodities. We may think about asset allocation in terms of geopolitical regions. So think about the United States, foreign developed countries, emerging markets. And then we think about asset allocation maybe in exposure to certain risk premiums or factors. Some of those factors or premiums have to do with whether you're in the market, meaning the stock market versus bonds, whether you're invested in small companies or value companies, companies with quality profits, company stocks that exhibit some kind of momentum. Maybe they're investing in the company itself. Maybe the stock is less liquid or more liquid. Maybe the company has a lot of leverage. They've done a lot of borrowing. All these factors have been analyzed by academics. And what they've looked at is whether or not there's a risk premium. In other words, is there a positive or negative factor associated with holding companies with these characteristics? When we think about that last bullet, risk premiums or risk factors, if we think about investing in general, the reason that we expect positive returns over long periods of time as investors is because we're willing to take on some risk of holding an asset. There needs to be some economic sense as to why the premium, in this case an increased expected return, might exist. Usually that's due to the underlying risk of volatility and uncertainty in terms of holding a kind of investment asset. So small companies, for example, tend to have more risk associated with them with larger companies. Therefore, the economic sense is if it's a riskier asset to hold, I should expect a higher rate of return over time. The other thing about these risk factors is in academic studies, they've been relatively persistent and pervasive across many time periods. What that means by persistence, you see it throughout history over long periods of time. And if you do different tests in different periods of time, you see those same premiums showing up. Pervasive means they show up in different markets. So if there's a small company risk premium in the United States, you'd expect to see that same small company premium appear in foreign developed markets and emerging markets. And indeed, in the small company case, they do. However, these things are called risk premiums for a reason because there's risk involved when an investor chooses to hold them as a part of their portfolio. While they have been historically shown to be relatively persistent and pervasive across many time periods, they're not present in every time period. In some time periods, the risk premium is actually negative, meaning it's underperforming the market generally or other kinds of assets that could have been held. The idea here is in holding a risk premium, what you're agreeing to do is hold a relatively risky asset in the expectation that over some longer period of time, you'll be rewarded with an increased expected return for holding that asset. The last bullet on the slide here says investors must be present to win. And the reason we say that they must be present to win is because these things don't happen all the time. And sometimes the higher expected return associated with these assets comes quickly in an unexpected fashion. If we look at the yearly observations of what's called the small company premium, going back to the 1920s, what you can see here is kind of a combination of years when the premium was positive, represented by the blue bars going up, and years when the premium was negative, meaning that large companies outperform small companies in those years where that red bar is negative. You can see in 5 of the last 6 years, the small company premium has been negative. The same thing is true for the value premium. So for investors who have held small companies and value companies as a larger part of their portfolio than they would have held in a market neutral portfolio, for example, those premiums have tended to take away from the overall portfolio performance. However, if we look long term, in this case, the small company premium, you can see that long term, very long term, going back to the 1920s, in this case, if an investor had held small companies versus large companies, they would have been rewarded with a premium of 3.79% per year. So how has this worked out really in this century? And I want to kind of quickly look at this because I think this is the question that our investors have been asking us. If we look at the last decade, so really since January 1st of 2010 through March 31st of 2020, what we see here is kind of what you'd expect to see, given that the fact that value and small premiums have been negative in 5 of the last 6 years. I've circled the Russell 2000 index and the Russell 2000 value index because that index measures small companies, the Russell 2000, or small value companies, the Russell 2000 value index. You can see at the top of the chart, in other words, the top performing asset class in the last decade or so has been U.S. large companies, and particularly U.S. large technology companies. So the NASDAQ Composite Index is right there at the top. And then you see the S&P 500 Growth Index, followed by the S&P 500 Index, just broad market measurement. Let's look at another time period. So this is the first decade of the 21st century, 2000 to 2009. And here we see almost the exact reverse. In this 10-year period, those risk premiums, small in value, ended up virtually at the top of the list. Real estate, or REITs, is at the top of the list for this time period, but you can see the Russell 2000 value and the Russell 2000 index were top performing indexes or asset classes in this 10-year period. So investors who chose to move their portfolio or at least overweight their portfolio to these risk premiums could have seen an additive benefit to holding those premiums in their investment portfolio. Now let's look at the entire time period. So here we are starting in January 1st of 2000 going to March 31st of 2020. And this is what we mean by a long-term risk premium. In this case, if we look over both periods, so the first period, 2000-2009, was really good for those risk premiums. The second period was not very good. But over the long-term history, 20 years and 3 months, those same risk premiums, the Russell 2000 Value Index and the Russell 2000 Index, so small companies and small value companies, were outperforming their large company counterparts, which appear more at the bottom. You can see the S&P 500 Growth Index, the NASDAQ Composite. They're the 2 of the 3 bottom lines. Over this entire period, the MSCI All Country World ex-USA, so foreign companies, have tended to underperform for long periods of time. Now let's look at how this same performance translates to funds. So we looked at indexes, which measure just kind of market indices. They're not investable. They don't have any fees associated with them. The question investors ask is, well, okay, that's fine for how the market did. How have the funds done that try to get that part of the market exposure, that try to capture that risk premium? What we'll see here is the same thing holds true. Again, looking at 2010 to March 31st, 2020, we'll see that the S&P 500 Growth Index is sitting on top, followed by the S&P 500 Index, which is a fund actually provided by Schwab. Then if you look down the list, Foster Group, we use a bunch of funds manufactured by the Vanguard company, is also by Dimensional Fund Advisors. You'll see there their Vanguard Small Cap Index, the DFA US Microcap Portfolio, the Vanguard Small Cap Value, and DFA US Small Cap Value. They all appear near the bottom of the list, just like the Russell 2000, just like the Russell 2000 Value for this time period. We switch time periods again to that first decade of the century. What you see is just what we saw with indexes. Those funds that target those small and small value premiums are up near the top of the list in terms of relative performance based on these other asset classes. If we look at the entire time period, same thing holds true. What you see is those small company stocks represented and invested in by the Vanguard US Small Cap Value Fund, DFA USA Small Cap Value, and the DFA US Microcap, which all focus on small companies and small value companies. They're sitting at the top of the list or near the top, showing that investors who favored those securities as a part of their portfolio would have received likely some additive benefit to overweighting those parts of the market, those risk premiums. Again, the risk premiums, because in the last 10 years, those funds have performed near the bottom of the list of securities we're looking at here, which goes back to something we talked about last week, which is the need to be diversified through all time periods if investors want to have a reasonably even portfolio experience investing in all different time frames. One thing to notice here is you'll see that real estate has looked pretty good in each decade, and it sits here at the top of the list in our chart. Now let's look at the numbers behind those things. So again, we'll start with the indexes, and we'll look from 2000, January 1st of 2000, all the way through March 31st of 2020. And I've broken the returns into those decade periods. So the first decade, 2000 to 2009, what you see is that Russell 2000 index and the Russell 2000 value in green. The other one in green is the Dow Jones US Select REIT. So the top three performing asset classes in that first decade of the 21st century were small companies, small value companies, and REITs or real estate. Go to the next decade, 2010 to 2020, you'll see kind of the reverse. Now the things that trailed the asset classes in the red, S&P 500, the S&P 500 Growth Index, and the NASDAQ Composite, the ones that struggled in that first decade of the century, they came back and performed quite well from 2010 to 2020. They were the top three performing asset classes, the S&P 500, that S&P 500 Growth, and the NASDAQ Composite. You'll see that the other asset classes had positive performance in that same period as well, just not as positive as those three. If we look at the picture for the entire period, what you'll see is the risk premiums associated with small and small value were among the top three performing asset classes for the entire 20-year and 3-month period, along with that Dow Jones US Select REIT. You'll see the worst performing asset classes for that full period, 2000 to 2020, included the S&P 500 Growth Index, the NASDAQ Composite Index, and the MSCI Country World ex-US. A little more recently, though, I think what investors are feeling when they look at their portfolios or when they look at kind of statements and what's going on in the world is the one-year total return listed in that bottom row. So here I've looked at the last 12 months, starting in April 1st of 2019, going through the end of March of 2020. And you'll see those risk premiums appearing as negative risk, right? You'll see the Russell 2000 index and the Russell 2000 value both down over 20% for the period. You'll also see that Dow Jones US Select REIT down over 20% for the period, while those US larger companies, the S&P 500, the S&P 500 Growth, and the NASDAQ, are near the top of the list in terms of their top performing asset classes, but two of the three are still performing with a negative number. Some folks have asked, well, gosh, that's a pretty rough number for the Russell 2000, the Russell 2000 value. Has it ever been worse? And the answer is absolutely, it has been worse. That Russell 2000 was down 42.3% for the year ended February 28 of 2009. And the Russell 2000 value was down 43% for the 12 months ended on February 28th of 2009. What we're seeing here is the numbers aren't unprecedented. They are negative. No one likes to see that kind of red number. But again, if we look to the entire 20-year experience, going from 2000 to 2020, you'll see that the risk premiums for people who held them, they tended to have a positive expected return and to reward investors. There's no guarantee that that will always be the case or that'll be the case again. But that's the point of a risk premium. You hold them because there's an economic sensibility as to why you think they have a higher expected return, so that you know you won't get that higher expected return every year. This last chart looks at those funds that we use to try to target those premiums. And again, what we're seeing here is the same thing that we saw before, where the funds that are targeting the premiums are getting pretty much the same returns as the market indexes that track the premiums as well. So if we look at the annualized returns from 2000 to 2009, you see the top three performing funds representing the asset classes, the DFA US Small Cap Value, and then you'll see the DFA Real Estate Securities and the Vanguard Real Estate Index as well in that top three. You'll also note that the DFA U.S. microcap and the Vanguard small cap index had positive returns in that first decade. Then we switched to the next decade, 2010 to 2020. Again, you'll see the things roll to the top, the Schwab S&P 500 index and the S&P 500 growth index. So just what we would expect, growth companies have done very well in the last 10 years. But if you look again at the last 10 years, going back to 2010, the DFA US microcap, the Vanguard small cap index, they had very positive returns, just not as positive as those large companies in the United States. And again, if you look all the way to the right, the Vanguard Developed Markets Index, which is reflecting what's happening in international stocks, it's just not been a great 20-year period for international stocks. Look at that bottom column there, or bottom row, and you'll see again the same thing that we saw in the indexes. It has been a difficult 12 months for small and small value. However, if you look at the Schwab S&P 500, the S&P 500 growth, and even DFA real estate securities, which are the top 3 performing funds, at least in this chart for that time period, even though they are the top 3 performing, they were still negative over the last 12 months. These charts aren't really meant to indicate which funds are going to do necessarily better going forward or they've done worse in the past. What they're trying to illustrate is by exposing a portfolio to different asset classes or different premiums, the investor gets different kinds of results. Over the long period of time, we think that having some additional exposure to small companies and small value companies provides the investor with a higher expected rate of return. Again, it's a higher long-term expected rate of return. We don't know for sure that it will happen or when it's going to happen, but there's some economic sense as to why we think it should happen and why these funds that have captured those premiums in the past, we think are likely to capture those premiums again in the future. The last slide for our conversation this week, we always like to end with a quote. Today's closing quote is from Warren Buffett's mentor and a legendary investor himself, Ben Graham. Ben Graham says this about the market. The market is not a weighing machine on which the value of each issue is recorded by an exact and impersonal mechanism in accordance with its specific qualities. Rather, we should say that the market is a voting machine whereon countless individuals register choices which are the product partly of reason and partly of emotion. When we look at what happens in markets from day to day and week to week, we obviously recognize this is true. Markets are not precise measures of the exact value of a company on a day-to-day basis. They reflect the opinions of millions of people who are making decisions based on how they think the company might do, how they think the economy will do. In this period of COVID-19, they're making decisions on how they think the economy will do relative to public health. There's a lot of things that go into people's opinion and their optimism or pessimism about the future. All those things are reflected in the way people price stocks, whether they choose to buy them or sell them on a daily basis. As always, it's a pleasure to talk with you each week. If you have any questions or you'd like to meet with a Foster Group advisor, please contact us. If you'd like to submit a question for us to talk about in our weekly market and financial update, please do that. We'd welcome that. The things we talked about this week are in direct responses to some questions from clients. Our team is fully engaged every day. We can get online with you and have a conversation face-to-face. We'd love to do that. Again, thanks for watching, and we hope to see you next week.